Many investors claim that to learn about investing, it's enough to read Buffett's letters to shareholders. If you can understand them, you don't need other books. If not, other books won't help. In the business world, Buffett's letters to shareholders hold a unique status, often hailed as the Bible of investing. In 1971, Warren Buffett's Berkshire Hathaway delivered a stunning report card. Its return on equity, ROE, reached a remarkable 14%, far exceeding the industry average. Behind these results was a strategic deployment across three main businesses. The insurance business became the growth engine, with premiums at National Indemnity surging, the reinsurance business doubling in size within 2 years, and the newly acquired home and automobile insurance company contributing $7.5 million in annual premiums. The banking division, meanwhile, achieved a miraculous 2% after-tax net interest margin, remaining profitable even under the unfavorable condition of having 50% of its deposits in high-interest time accounts. And while the textile business faced an industry-wide downturn, it avoided major losses through meticulous management, hinting at Buffett's decisiveness to cut off a limb to survive. Even more astonishingly, Buffett issued an early warning about an overheating industry, adhering to the principle of it's better to earn less than to lose principal, and in doing so, was fully prepared for the 1973 to 74 market crash. This letter perfectly showcases how Buffett used the golden combination of insurance float and banking leverage to find opportunities in times of crisis. Here is the full text of Warren Buffett's 1971 letter to shareholders. To the stockholders of Berkshire Hathaway Incorporated, it is a pleasure to report that operating earnings in 1971, excluding capital gains, amounted to more than 14% of beginning shareholders' equity. This result, considerably above the average of American industry, was achieved in the face of inadequate earnings in our textile operation, making clear the benefits of redeployment of capital inaugurated 5 years ago. It will continue to be the objective of management to improve return on total capitalization, long-term debt plus equity, as well as the return on equity capital. However, it should be realized that merely maintaining the present relatively high rate of return may well prove more difficult than was improvement from the very low levels of return which prevailed throughout most of the 1960s. Textile operations. We, in common with most of the textile industry, continued to struggle throughout 1971 with inadequate gross margins. Strong efforts to hammer down costs and a continuous search for less price-sensitive fabrics produced only marginal profits. However, without these efforts, we would have operated substantially in the red. Employment was more stable throughout the year as our program to improve control of inventories achieved reasonable success. As mentioned last year, Ken Chase and his management group have been swimming against a strong industry tide. This negative environment has only caused them to intensify their efforts. Currently, we are witnessing a mild industry pickup, which we intend to maximize with our greatly strengthened sales force. With improvement now seen in volume and mix of business, we would expect better profitability, although not of a dramatic nature, from our textile operation in 1972. Insurance operations. An unusual combination of factors, reduced auto accident frequency, sharply higher effective rates in large volume lines, and the absence of major catastrophes, produced an extraordinarily good year for the property and casualty insurance industry. We shared in these benefits, although they are not without their negative connotations. Our traditional business, and still our largest segment, is in the specialized policy or non-standard insured. When standard markets become tight because of unprofitable industry underwriting, we experience substantial volume increases as producers look to us. This was the condition several years ago and largely account for the surge of direct volume experienced in 1970 and 1971. Now, that underwriting has turned very profitable on an industry-wide basis. More companies are seeking the insureds they were rejecting ashort, while back-end rates are being cut in some areas. We continue to have underwriting profitability as our primary goal, and this may well mean a substantial decrease in National Indemnity's direct volume during 1972. Jack Ringwalt and Phil Leach continue to guide this operation in a manner matched by very few in the business. Our reinsurance business, which has been developed to a substantial operation in just 2 years by the outstanding efforts of George Young, faces much the same situation. We entered the reinsurance business late in 1969 at a time when rates had risen substantially and capacity was tight. The reinsurance industry was exceptionally profitable in 1971, and we are now seeing rate cutting as well as the formation of well-capitalized, aggressive new competitors. These lower rates are frequently accompanied by greater exposure. Against this background, we expect to see our business curtailed somewhat in 1972. We set no volume goals in our insurance business generally, and certainly not in reinsurance, as virtually any volume can be achieved if profitability standards are ignored. When catastrophes occur and underwriting experience sours, we plan to have the resources available to handle the increasing volume, which we will then expect to be available at proper prices. We inaugurated our home state insurance operation in 1970 by the formation of Cornhusker Casualty Company. To date, this has worked well from both a marketing and an underwriting standpoint. We have therefore further developed this approach by the formation of Lakeland Fire and Casualty Company in Minnesota during 1971 and Texas United Insurance in 1972. Each of these companies will devote its entire efforts to a single state seeking to bring the agents and insureds of its area a combination of large company capability and small company accessibility and sensitivity. John Ringwalt has been in overall charge of this operation since inception. Combining hard work with imagination and intelligence, he has transformed an idea into a well-organized business. The home state companies are still very small, accounting for a little over $1.5 million in premium volume during 1971. It looks as though this volume will more than double in 1972, and we will develop a more creditable base upon which to evaluate underwriting performance. A highlight of 1971 was the acquisition of Home and Automobile Insurance Company, located in Chicago. This company was built by Victor Robb from a small initial investment into a major auto insurer in Cook County, writing about $7.5 million in premium volume during 1971. Vic is cut from the same cloth as Jack Ringwalt and Gene Abegg, with a talent for operating profitably accompanied by enthusiasm for his business. These 3 men have built their companies from scratch and, after selling their ownership position for cash, retain every bit of the proprietary interest and pride that they have always had. While Vic has multiplied the original equity of Home and Auto many times since its founding, his ideas and talents have always been circumscribed by his capital base. We have added capital funds to the company, which will enable it to establish branch operations, extending its highly concentrated and on-the-spot marketing and claims approach to other densely populated areas. All in all, it is questionable whether volume added by Home and Auto, plus the home state business in 1972, will offset possible declines in direct and reinsurance business of National Indemnity Company. However, our large volume gains in 1970 and 1971 brought in additional funds for investment at a time of high interest rates, which will be of continuing benefit in future years. Thus, despite the unimpressive prospects regarding premium volume, the outlook for investment income and overall earnings from insurance in 1972 is reasonably good. Banking operations. Our banking subsidiary, the Illinois National Bank and Trust Company, continued to lead its industry as measured by earnings as a percentage of deposits. In 1971, Illinois National earned well over 2% after tax on average deposits, while 1, not using borrowed funds except for very occasional reserve balancing transactions. 2, maintaining a liquidity position far above average. 3, recording loan losses far below average. And 4, utilizing a mix of over 50% time deposits with all consumer savings accounts receiving maximum permitted interest rates throughout the year. This reflects a superb management job by Gene Abegg and Bob Klein. Interest rates received on loans and investments were down substantially throughout the banking industry during 1971. In the last few years, Illinois National's mix of deposits has moved considerably more than the industry average away from demand money to much more expensive time money. For example, interest paid on deposits has gone from under $1.7 million in 1969 to over $2.7 million in 1971. Nevertheless, the unusual profitability of the bank has been maintained. Marketing efforts were intensified during the year with excellent results. With interest rates even lower now than in 1971, the banking industry is going to have trouble achieving gains in earnings during 1972. Our deposit gains at Illinois National continue to come in the time money area, which produces only very marginal incremental income at present. It will take very close cost control to enable Illinois National to maintain its 1971 level of earnings during 1972. Financial. Because of the volume gains being experienced by our insurance subsidiaries early in 1971, we recast Berkshire Hathaway's bank loan so as to provide those companies with additional capital funds. This financing turned out to be particularly propitious when the opportunity to purchase home and auto occurred later in the year. Our insurance and banking subsidiaries possess a fiduciary relationship with the public. We retain a fundamental belief in operating from a very strongly financed position, so as to be in a position to unquestionably fulfill our responsibilities. Thus, we will continue to map our financial future for maximum financial strength in our subsidiaries as well as at the parent company level. Warren Buffett, March 13, 1972.